Hey, Andrew Georgitsis here from SoCal Realty and Investments. Well, welcome to today's show. Today, I want to discuss a little bit about another fantastic tool we have, which is called Assumable Loans. Now, this may be a new subject to a lot of people, but yes, there are loans out there that you can assume. Generally, they are VA loans or FHA loans. And a lot of people don't know much about it. But why an assumable loan? Well, let's just say that in today's market, where rates are 6.5% to 7%, okay, an assumable loan means that you'll take over somebody's loan who they may have got during, let's say, the more better times when loan rates were 2.25%, 2.3%, 2.4%, 3%, any of those types of things. And what that means is you're going to assume the entire loan. You're going to assume all of the debt and the responsibility of the loan. The seller will release and will be released of all of the responsibility of the loan and the debt, even if you default. So it really works in both your favor, because what you're getting is you're getting the rates from, let's say, 2019, 2020, when you could get a loan for 2.25%. And the seller gets to sell the house and be released of all the responsibilities of that loan. And the seller sells the house. Now, why would you want to assume a loan? Because you're going to save thousands in interest payments. Thousands, I mean thousands. So I have an interested buyer who's looking for a place here in Carlsbad, and she specifically wanted a condo. So unlike Zillow, when I go on Zillow and I look over here and I look at all the facts on the condo, I don't know that this is an assumable loan. I just see it's been on the market 101 days. It's a townhome, where it's located. I see some basics about it. Of course, this you can find anywhere. So all they're drawing this from is from the MLS. So there's nothing new or fancy in this information. And this is your general information to all consumers. So it's funny because a lot of people shop using Zillow, but in fact, it's a bad tool. It doesn't really show you anything. It's like, okay, there's the price history, what it sold for back when, some tax history. Even this doesn't give you any accurate information. Look, it's showing you you're going to pay 5,515 a month if you put 24,000 down. Well, $800,000 home, that's a 3% down. So you would have to pay mortgage insurance. Right here, look at this. It's showing you mortgage insurance zero. Even if you click and unclick, it still shows you zero. Even so, you're telling it, I don't have the full 20% down payment. So yes, in all mortgages, okay, not VA, but in your general conventional mortgage, FHA and so forth mortgage, if you don't put 20% down, you're a first-time buyer or whatever, you don't have that 20%. So 20% of 800,000 would be 160,000 or more to put down. You have to pay PMI, which is your mortgage insurance, property mortgage insurance. And you can see it shows you no. So look how wrong this information is. It's there's 24,000 showing you don't have to pay any. It's BS. So the reality is it can be anywhere from 1 to 1.75%. Okay. And so if you're looking at that and you say, wow, okay, so now all of a sudden, if I only put 24,000 down, I'm going to be 6,500 or more in payments, monthly payments. Okay. Now, if I take over somebody's loan, I don't need that 20% down. I just need the difference between the asking price and the loan. Okay. That's called the cash gap. So if they're asking 799,000 and they have a loan for 750,000, you only have to have 49,000. And no, you won't have to pay the PMI if it's a VA loan, for example. You don't have to do that. So you can assume a VA loan, even so you don't have VA benefits. And contrary to belief, popular belief, yes, the VA person giving you the assumable loan will lose that portion of their total allowance, but not their whole VO allowance. So, for example, in San Diego County, a VA allowance might be I think it's $1,154. So if they're giving you a loan for $500,000, they still have $600,054 available in their VA benefits for their next purchase. So, they may not even need all of that. So there's a lot of ways to get around the VA thing, and you don't have to be a VA member to get the loan. So let's look at my example. Here's my example for the condo. So this is a tool that I have, and I can look at all the same property information. So it's all the same stuff. But the stuff that I'm really interested in, yes, is the 799. And of course, when we go to buy this property, it's been on the market for 110 days. So believe me, we're going to negotiate that price, okay? But maybe you're going to get it at 750. I don't really know. But here's what's important. Look where it says estimated loan balance. So we have a tool that's now we know we've pulled the data and we know what their loan. And we look at that loan and we say, oh, they owe $578 and $258. So that means the difference between that and the asking price or the negotiated what that you end up selling is called the cash gap. So my buyer would need to, in this case, at full price, need $221 cash. But of course, we can negotiate that. And if they don't have cash, we can always get a sub loan, a smaller loan, a HELOC that can basically fill in the gap between those two. But we'll get to that later. But if you look here, okay, so you got you need that cash gap. It is a VA loan, so my buyer unfortunately is not a VA person. But like I said, the loan is $578, and the VA person has benefits of $1.154 million. So actually, they'll still have an additional 500 and whatever the difference is, $550,000 worth of VA benefits. So this may not affect them to give us the loan because the VA benefits stay with the loan. So when you assume the loan, the VA benefits of $578 stay with that loan until either you refi or you sell the property, and then those go back to the original person. But anyway, a lot of little interests to them. Now, look at their estimated mortgage payment. They're paying $327.57 versus we already said it's going to be $5,500 plus PMI. That's going to be $6,500 instead of $3,200 to $3,257. I mean, that's like $2,000 savings because you're not paying the PMI, you're not paying the additional interest. Okay, yes, they got 25 years left, and this was the original loan. You can see the condo. And here's what's really important is you're assuming the loan at 2.59, okay, rather than 6.21 today's rates. So you can see the savings just in interest is $1,000. Never mind that you're not going to have to pay PMI. Now, you're right. If you had $221,000 to put down, agreed, that's more than 20%, so you wouldn't have to pay PMI anyway. But as you can see, that's still $1,000 just in interest every month. That's $12,000 a year. You keep this place for 10 years, that's $120,000 in savings just because you assumed this loan. $120,000 in savings over the 10-year period of the hold, or 5 years or whatever. So, I mean, wow, that's a massive savings. Okay? Well, not 986 to be precise, but I'm rounding the numbers. It's giving you the idea. Now, of course, again, we've talked about this. You still have to pay the property tax, of course, but you won't have that homeowner's insurance. Now, because it was an FHA, you won't have it. And the condo fees here are $740, which are included in that payment. So imagine that, right? Now you're looking at this and you're going, okay, what if I only came in with, let's say, $80,000? All right. Now, or even less. Let's say I came in with $39,000. So I came in with $40,000. So it's still that above that 3%. It's that, it's like a 4% or whatever. It's going to be that, whatever you call it, a little less than 4% down payment. All right. But on an FHA, I would have to pay the mortgage insurance. Well, in this case, you don't, but you will have to get a second mortgage. And you can see that second mortgage will be of $180,000. Of course, it'll be a little bit higher interest, but the combined interest between the two, you can get a blend. So the blend would be, yes, you're borrowing at 6.21, the 180, but you're also borrowing the 500,000 at 2.67. And so the combined is 5.82. So you're still getting a great rate, still better than normal. And your second mortgage payment would be $1,638. But still, if you combine those two, you're only at a full payment of $4,895. So you're still better than the $6,200 or $6,500 if you were just to go at this alone. If you were just to put this, what did I just say? We're going to put down, if we're going to put down 39,000. So if you're going to come in here and you're going to put down, say, 40,000, just for the ease of numbers, I mean, it doesn't really matter, okay? And you can still see that this stupid thing tells you don't have any PMI, all right? But you can see you got a 5,515 plus PMI. PMI, could be, 1.75%. So it could be another, $800-900. So you're looking at $6,500 payment plus your HOA. So, you're looking at $7,500 a month to live there versus $4,800. So you can see that's a $2,500 savings because you're not paying PMI, all right? And because you're not paying that additional interest premium of $1,000 a month. So you're not paying PMI, you're not paying. So even if you only had a very small down payment, you could still get into this VA loan. You could still get into this VA loan and get the benefits of the VA, which is no PMI, right? Which is fantastic. The low interest rate of, what was that again on this particular one? It says it right up here. The low interest rate was what was the loan again? It was 2.59. So really, really great interest rate. And because of the second loan, your combined would be 5.82, which is still better than 6.21. So you're still getting a better interest rate, and you're saving yourself the PMI, and you're saving yourself interest. Anyways, if you want to learn more about assumables and how we handle them and where we look and how to search for them and how you can save literally hundreds of thousands of dollars in interest payments, click the link below. That's very important to click that link below and shoot me an email, give me a call, and let's sit down and discuss. And we can work through a couple scenarios so I can show you how you can save money. Besides, picking the perfect property. I mean, that's the other thing, of course, is you can go in and you can look at the properties, and you can see, all of these are all assumables. And so that allows me to save a lot of money when I'm looking around a property. I know buying a home and choosing the right property for you is also important from a feeling aspect of like, hey, how do I feel in the home? What, maybe it's too many stories or not enough bathrooms, whatever it is. I get it. I agree. You still have to feel, we still have to see the home, it still has to be the perfect home for you. But if I can save you $120,000 over a 5-year period in interest and PMI, come on, why take advantage of that? So again, click that link below and let's chat.